Welcome to the deep dive. We cut through the noise, get straight to the insights. Today, we're tackling one of those, really dense financial reports.
Yeah.
It's the half-year statement from a major UK banking group for the first half of 2025. Our mission, simple: give you a clear shortcut, help you understand not just the numbers, but what they really mean for their health, their strategy, and yeah, even for the wider UK economy. There are actually some surprising things in here, so let's get into it.
Exactly. And these kinds of reports, they're a fantastic lens. Seriously. These big financial statements, they offer so much more than just one company's figures. They give us a really crucial snapshot, helps us gauge resilience, strategic shifts, across the UK economy. We're looking at Jan to June 2025 here. And yeah, there's quite a story packed into these pages.
Okay, let's unpack this then. The report kicks off really strong. It declares sustained strength in financial performance. But what does that actually, translate to? What are the real results that make you sit up and pay attention?
Well, it means they've seen pretty robust growth across key areas, even while, navigating what's still a complex economic picture. Take the statutory profit after tax, that climbed to a healthy £2.5 billion, which is a solid increase from £2.4 billion in the first half of last year, 2024. So that's a clear signal, right? They're generating earnings effectively.
That is a notable uplift, yeah.
Yeah.
So where did that extra income come from? What were the main drivers?
A couple of big things, really. Their underlying net interest income, that's basically the bread and butter, profit from lending and deposits that rose 5% to £6.7 billion, and their banking net interest margin, the spread they make, stood at a healthy 3.04%. But what's also really interesting is this pretty significant 9% jump in underlying other income. That hit 3.0 billion. And that's not from traditional lending. It's more about stronger customer activity in other services, strategic initiatives paying off, shows a bit more diversity in how they make money.
Right, so not just relying on the core banking stuff, they're seeing good performance elsewhere too. What about costs? Were they keeping a lid on things, especially with inflation still being a factor?
Relatively speaking, yes. Operating costs did go up 4% to £4.9 billion. But the report makes a point of saying this was partly offset by, active cost savings and continued cost discipline, as they put it. And you see that efficiency focus in their cost-to-income ratio. That actually improved, went down to 55.1% from 57.1%. That ratio is key, tells you how much it costs them to make each pound of income. Lower is generally better. And their ROTE return on tangible equity, a really robust 14.1%. That's a crucial measure of how well they use shareholder money to make profit. Strong number.
Okay, 14.1%. And for shareholders, sounds like this performance is turning into, actual cash.
Absolutely. The interim ordinary dividend got a very healthy 15% boost, up to 1.22 pence per share, which works out to 731 million being distributed back to shareholders. That signals real confidence in their performance and, the outlook.
Okay, so profits are up, dividends are up, but let's look beyond the headlines. The real pulse of a bank often is in that flow of money, isn't it? Lending out, taking in deposits. This gives us a clearer picture of their core business and maybe wider economic trends too. What's the story there?
Yeah, this is where you really see their impact on the ground. Underlying loans and advances to customers grew by an impressive 11.9 billion. That's 3% in just 6 months, reaching 471 billion total. And it wasn't just one niche. Retail banking, especially UK mortgages, was a big driver. Mortgages alone went up to nearly 318 billion. Says there's strong customer demand there. Commercial banking saw decent growth too. So yeah, they're actively lending, supporting homeowners and businesses.
And are people putting their money with them? How did the deposit side look?
Very strong, actually. Customer deposits increased significantly, up 11.2 billion, that's 2%, hitting 493.9 billion. That includes good growth in retail deposits, driven by savings, obviously, but also a really strong IS season. They opened over 375,000 cash ISAs, and commercial banking also saw substantial deposit growth, so confidence from both individuals and businesses seems high.
That does sound like a healthy balance sheet, both sides growing. So how does that translate into overall stability, capital buffers, liquidity? Can they handle shocks? Well, they generated strong capital. Pro forma capital generation was 86 basis points. That feeds into a healthy CET1 ratio, Common Equity Tier 1 of 13.8%. Now, think of CET1 as the bank's main safety net, right? Its core capital strength against losses. 13.8%. That's a robust buffer, well above what regulators require. Their loan-to-deposit ratio also held steady at 95%, which basically means their lending is well covered by stable customer deposits. Good funding position. And adding to that, their liquidity coverage ratio, LCR, was 145%. Their net stable funding ratio, NSFR, 127%. Bit technical, I know, but essentially, they have plenty of liquid assets for short-term needs and stable funding for the long run. It's very reassuring, like a well-stocked pantry.
Right, a solid foundation. Now, the report talks a lot about their purpose-driven strategy in helping Britain prosper. Beyond the financials, what does this actually mean on the ground? For the UK, for customers, where do the numbers meet the real world?
Yeah, this is where their strategy gets sort of tangible. In housing, for example, they mention lending over $100 billion to first-time buyers since 2018 and supporting over $20 billion in funding for the social housing sector. That's significant scale. They've even just launched a new $50 million lending partnership with the Royal Foundation's Homewards program, specifically aimed at tackling homelessness, so it goes beyond just standard mortgages.
That is a major commitment, a direct social impact. What else? Are they empowering customers financially in other ways?
Definitely. They highlighted a ready-made pensions product. And what's interesting there is that about 40% of the over 4,000 accounts opened are for self-employed customers. That's a group often, underserved by traditional pensions, so it helps fill a gap. They also launched a new lifetime investment default fund for pensions, trying to simplify things for people.
Okay. And the environment. Net zero is a big topic. Are we seeing concrete steps here beyond just talk?
They seem to be making real headway. In the first half of this year alone, they provided around £9 billion in sustainable financing. That brings their total since 2022 to over £57 billion. And it's not just big numbers. It includes targeted things like £60 million for sustainable retrofitting of social homes in London and the Southeast. And they acted as global coordinator on the first sterling blue bond. That's for ocean health projects. Plus, their climate-aware investments are now at $37.1 billion. That's already beaten their 2025 target. So it does suggest a real shift in focus.
That's concrete action, yeah. Impressive scale, too. And digitally. A bank this size has to be pushing forward there.
Oh, absolutely. They call themselves the largest digital bank in the UK for retail. And in commercial banking, they've digitized over 40% of key servicing interactions. That's not just fluff. It improves things for customers, makes the bank more efficient. And in their insurance, pensions, and investments division, over 500,000 customers are using their main app for workplace pensions. And the take-up rate for protection, like life insurance for mortgage customers, has increased notably to 20%. Suggests better engagement, which is good.
But, okay, can't all be smooth sailing. The report is pretty upfront about significant risks, uncertainties. What are the main challenges they're flagging? Because understanding the potential bumps in the road is just as vital, right?
You're absolutely right. No good report ignores the risks. And a big one right now, casting a bit of a shadow, is the Motor Finance Commission review. This relates back to historical commission setups on car loans. The Supreme Court appeal hearing finished in April, but as of late July, the judgment was still pending. The FCA, the regulator, also has temporary complaint rules in place, so the bank. They've put aside a pretty hefty provision, $1.15 billion, to cover potential outcomes from various scenarios. It's definitely an area of significant uncertainty, financially and, reputationally, until that judgment lands.
Okay, $1.15 billion set aside. That's a big unknown hanging over them. Any other legal or regulatory clouds on the horizon?
Yes, they mention others too, things like the HBOS reading review that involves fixed compensation payouts, some leftover PPI stuff as well. And there's also a significant tax dispute with HMRC. Over $975 million. The company is appealing that one. Now, they've already paid the tax to HMRC, but they're currently treating it as an asset on their books, hoping to get it back. The appeal outcome is obviously uncertain.
Interesting. And it's fascinating how they prep for wider economic storms. What's their latest view on the economy, and how are they stress testing for, the really bad scenarios?
Well, their main economic forecast, their base case expects slow GDP growth, bit of a rise in unemployment, small gains in house prices, and the bank rate gradually coming down. Kind of a sluggish picture. But they don't just plan for that. They're part of the Bank of England's big 2025 stress test, and that simulates a really severe scenario. A global supply shock, UK GDP falling 5%, unemployment and inflation spiking, interest rates hitting 8%, proper doom and gloom stuff. Testing against that is crucial. Make sure the system can cope. The results for this specific bank are due out later this year, Q4 2025.
Wow, 8% rates, 5% GDP drop. That's quite the storm they're modeling. Shows the level of caution from the regulators. And linked to that, what about actual loan quality? Their rainy day fund for defaults and the impairment charge. How's that looking?
The underlying impairment charge was $442 million for the first half. Now, that is up quite a bit from 101 million in the same period last year. But the report suggests this was driven partly by a higher charge in commercial banking, linked to just a small number of specific cases turning bad rather than, say, a widespread problem across the board. So, overall asset quality is still described as robust. Interestingly, though, they have added a new 50 million judgmental adjustment, specifically for global tariff and geopolitical disruption risks in commercial banking, shows they're keeping a very close eye on those emerging global threats.
It really raises that question, doesn't it? How does a huge financial group like this manage that balancing act? Delivering strong results now while actively prepping for all these varied, uncertain challenges is like walking a tightrope, but with a very big, very expensive safety net below.
It really is about that balance, yeah. It points to proactive risk management, strong capital buffers like we discussed, and just constant monitoring. They're trying to ensure they've got the financial muscle to absorb shocks if they happen, while still investing for growth and, delivering on that purpose strategy, building resilience, basically.
Right. And despite all these challenges, all these uncertainties we've just talked about, they sound pretty confident looking ahead. Reaffirming guidance, sticking to ambitious targets. What are they actually committing to, short and medium term?
Yeah, their 2025 guidance is reaffirmed, which shows confidence in the immediate future. Key targets there include underlying net interest income around 13.5 billion, operating costs near 9.7 billion, and importantly, an asset quality ratio of about 25 basis points. That signals very low expected loan losses. They're also still aiming for that return on tangible equity around 13.5% and generating about 175 basis points of capital. Strong capital build.
Okay, clear goals for this year. And looking further out to 2026, are the targets getting even tougher?
They've maintained their 2026 guidance too. And yes, it's ambitious. They're projecting a cost-to-income ratio below 50%, so even more efficiency. Plus, aiming for a return on tangible equity greater than 15%, that would be a really strong profitability level, and capital generation over 200 basis points. They also plan to manage their CET1 ratio down slightly, towards 13.0%, probably returning more capital while staying very robust. These targets, they say, are based on current economic assumptions and their confidence in their strategy, which they describe as building a highly differentiated franchise. Suggests they believe their specific approach will keep driving results.
So, as we've seen today, you peel back the layers of a big bank's report. And it's not just profit and loss. It's this complex dance of economic forces, strategic bets, risk management, and yet even real societal impacts. This deep dive into their first half results, it suggests, well, a pretty resilient performance from this group, despite those headwinds and uncertainties we talked about. So the question for you to think about is, what does this tell us about the broader health of the UK economy? And how might these kinds of trends, the digital push, the focus on sustainability, the management of risk, how might they reshape the financial services you use every day? Keep digging, keep connecting those dots, and stay curious.